Hello and welcome to episode 36 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Surya and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Surya, and I currently attend the University of California, Los Angeles.
What we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com. Please take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
We are continuing with our new format this week by focusing on 4 key stories, including a deal between the satellite company EchoStar and SpaceX, shareholder opposition to Blackstone's take private of TaskUs, 2 different activists getting involved with the accounting and payment software company Bill.com, and then the largest corporate pay package in history. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more detail. We'll jump right into our podcast today with a look at deals in the works. On September 10th, Larry Ellison was briefly the richest man on Earth, overtaking Elon Musk. His net worth surged by $89 billion in a single day due to Oracle's stock price exploding after Oracle reported quarterly results that surpassed analyst expectations and then promised that there was more growth to come. There were quite a few jokes made that with this new bout of wealth, Larry Ellison's son, David Ellison, would have the financial backing to make a bid for Warner Bros. Discovery, much like how David founded his media company, Skydance Media, responsible for some of the Mission Impossible films and Star Trek films, which merged with Paramount earlier this year. No one really expected these jokes to lead anywhere, but the Wall Street Journal ended up reporting that Paramount Skydance was preparing a majority cash bid to acquire Warner Bros. Discovery, backed by none other than the Ellison family. The bid will be for the entire company, including its cable networks and movie studio. Apparently, the company is already working with an investment bank for the bid, and an official announcement could come as early as next week, but bear in mind that this is all speculation and no official announcement has been made just yet.
Yeah, it took a really long time for that Paramount deal to get inked, and it's surprising to even think that they might want to consider yet another deal. But consolidation in this very difficult industry makes a lot of sense. And what throws a little bit of a wrench into this whole thing is Warner Brothers Discovery's plan to basically spin off some of its divisions, right? What's happening on that front?
Exactly. Consolidation seems to be the name of the game for Paramount Skydance, but for Warner Bros. Discovery, it's the exact opposite, as it's in the middle of its own mess at the moment, trying to undo the merger between the 2 massive media and entertainment companies that was completed back in April 2022. The company announced in July of this year that it's set to split up into 2 independent, publicly traded companies by mid-2026. The high-growth studios and streaming operations will be one business, while the global network segment will be another. We have discussed this deal on our prior podcast episodes, so if there are any new viewers who want a little bit more detail, feel free to go back and listen to episodes 23 and 25.
Fascinating situation all over. At some point, I hope that our portfolio company, Lionsgate Studios, also catches a bid.
Hopefully.
Switching to current deal updates, a key story we wanted to discuss on this podcast was the deal the satellite and wireless networking company EchoStar struck with SpaceX last week. To understand how EchoStar ended up with a bunch of valuable spectrum, we need to go back in time. We don't have to go all the way back to when founder Charlie Ergen was selling satellite dishes from the back of his truck in the Denver area, but we just need to go back 2 years when Dish Networks and EchoStar announced that they were merging. Shortly after that merger announcement, we covered the bonds of Dish Networks that were trading at a distressed level in an article for a Yield Guru service operated by my friend Sailesh. He argued that the merger helped Dish address short-term liquidity concerns and discuss Dish's massive spectrum assets that it was carrying at a value of $37 billion on its balance sheet. And in the management presentations talking about the merger, they had indicated a value of about $35 billion for those spectrum assets. Some of the parts valuations for companies like EchoStar that assigned a value to the spectrum that they were holding have been floating around for years, but it's been hard to figure out if and when those assets could be monetized. One way to monetize is to build out a wireless network, the way Dish Network was doing before its merger with EchoStar. In fact, Dish had already finished rolling out its 5G network across more than 70% of the US. But you can imagine how capital intensive it would have been for the company to finish with the other 30% it did not already cover. The other way to monetize a spectrum is through a sale or a licensing agreement. And that is what we saw last week with the deal between EchoStar and SpaceX. SpaceX is paying a total of $17 billion, both in the form of paying down about $7.5 billion of EchoStar's debt and then paying interest on some of its convertible notes for 2 years. Depending on how much of those convertible notes actually convert to shares, the amount of debt SpaceX will pay off will vary. The more interesting part of the deal is that SpaceX is paying for a part of the deal through a stock exchange, and EchoStar will end up with $8.5 billion of SpaceX stock priced at $212 per share. This part of the deal propelled the stock of EchoStar higher as it now becomes a publicly traded proxy to get partial exposure to SpaceX, which despite its high valuation is still a private company.
I know it's a little bit insane. I can't believe how long these companies are staying private. I mean, what was SpaceX's valuation during its last round of funding?
I think they repurchased some shares from insiders of the company, and at that point, it was supposedly trading at $350 billion. Based on this current price that they're paying for EchoStar, it seems as though SpaceX is now valued at $400 billion. And so this 164% jump in EchoStar's stock over the last month begins to reflect that the markets are both pleased with the company deleveraging through this deal, and they also like the fact that EchoStar could now become a proxy for SpaceX, or in other words, it becomes a way to get exposure to SpaceX. Maybe EchoStar pulls off an open door and heads straight up to the skies.
Back in May of this year, Blackstone announced the take-private acquisition of TaskUs, a digital outsourcing services provider, along with the company's co-founders. The deal was a $1.62 billion all-cash deal, which works out to approximately $16.50 per share.
But isn't TaskUs currently trading at a little over $17 per share? That would basically make the deal have a negative spread of around 5%, wouldn't it?
Exactly, and that's why we're bringing this months-old deal up now. All the major deal milestones have been met, including the expiration of the waiting period under the HSR Act, which would mean normally that the stock would be trading at a spread close to zero. However, the last milestone that needs to be passed is shareholder approval, which is what seems to be causing the negative spread. Shortly before the deal was announced, TaskUs was trading at around $14 per share, so the $16.50 offer already represents a slight premium, but investors evidently want more. This isn't all that surprising because the company looks to be quite promising financially. Both the top and the bottom line have been growing steadily over the last few quarters.
Yeah, so I'm not surprised the shareholders have been holding back on the approvals, but do you think they'll be able to negotiate a higher price?
Quite frankly, common shareholders don't have much voting power. On May 23rd of this year, the company's co-founders exchanged 15 million of their Class B common stock for 15 million Class A common shares. After this, Blackstone and the co-founders of the company owned approximately 50.9% of all Class A shares, 100% of all Class B shares, and in total held roughly 80.5% of the company's outstanding shares and about 97% of total voting power. Because they control most of the Class A shares, all the Class B shares, and have existing agreements to vote for the merger, all required shareholder approvals, except for the majority of the minority vote, are essentially guaranteed. Despite this, minority investors are still speaking out. Merchants Unlimited, an activist firm led by Mark Bistricher, issued an open letter claiming that they would vote against the deal since they believed the price drastically undervalued TASUS, especially in the context of the business's current financial inflection. Murchison is demanding a price that is at least $19 per share, well above where TASUS is trading even now. That would be a big ask, if not for the fact that Think Investments, which owns about 23% of TASUS minority shares, also oppose the deal. Think Investments is going as far as to say that the fair value of TASUS is $25 per share, considering how well positioned the business is to embrace AI and the exclusion of relevant precedent transactions when coming to the final deal price that Blackstone offered. Institutional Shareholder Services, or ISS as it is better known, also recommended that investors reject the deal. This is extremely significant because we've talked rather extensively about the Dallas News deal in the past on this podcast, where constant higher offers have been made by M&G, and the company rejects them every time. However, despite the higher offers, ISS still encouraged shareholders of Dallas News to vote for the lower offer by Hearst. So for them to take a stand and also say that this deal is undervalued is quite significant. Blackstone isn't a small firm by any means, and it won't find it difficult necessarily to cough up the extra capital, but at the same time, they have a league of lawyers and professionals ready to make sure this deal goes through as is. The majority of the minority vote is the one thing in the way, and I'm curious to see how it'll all play out going forward. TASUS is a somewhat large company with a market cap of around $1.55 billion, so hopefully shareholder inaction will be less of a problem, as is the case with many micro-cap deals facing shareholder approvals.
That's fascinating, as you mentioned, how similar the Dallas News situation is to this one, with a large shareholder wanting the deal to go through in its current format, but how the shareholder services firms have gone the opposite direction in both deals. It'll be fascinating to see how it all finally plays out. Switching gears to new M&A activity, last week we talked about how the $28 billion acquisition of Air Lease by Sumitomo was the second largest acquisition announced this year. Well, that Air Lease acquisition sat at that second place just for 1 week, because this week we have a new contender for the second place position. The acquisition of Tech Resources by Anglo American for a closing value of $33.62 billion replaced the Air Lease deals at the top of the podium, or in the second spot at least. This acquisition of Tech Resources by Anglo American is an all-stock deal, and each Class A common share and Class B subordinate voting share of Tech will be exchanged for about 1.33 shares of Anglo American, implying a value of about $42 per share. The spread on the deal is large at over 11%, but some of them has to do with the fact that the deal is not expected to close until early 2027, and there are concerns that the Canadians may not be all that keen on having Anglo American acquire one of their largest mining companies. The part about the deal that really caught my eye was that there is the same exchange ratio for both Class A and Class B shares of Tech, which often trade at slightly different prices. So in addition to a potential merger arb opportunity, there might be a dual class arbitrage opportunity here as well.
Moving on to yet another announced merger, IAC, or Interactive Corp as it was once known, was one of the very first companies I ever wrote about. The business is best known for a series of incredibly successful spin-offs over the past 2 decades, including Ticketmaster, Expedia, and Match Group, which owns 2 out of the 3 largest dating apps, such as Hinge and Tinder. However, at some point, IAC's spin-off luck began to run out, and that started with the spin-off of Vimeo. Vimeo is a video hosting software platform, which could never quite compete with the content platforms like Netflix, Disney, Hulu, HBO, and more, or with the more casual social media video platforms like YouTube or TikTok. Since being spun out of IAC in May 2021, the company's stock price is down a whopping 85%, and that's after accounting for the 93% jump in the company's stock price recently, after it was announced that Bending Spoons would acquire the business for $1.38 billion.
I still remember when Vimeo came out, their main selling point to businesses was that video that was uploaded to Vimeo would be served at a higher quality, in HD quality, as well as without ads. But YouTube eventually introduced YouTube Premium without ads, and they added on that HD quality video as well, which disrupted Vimeo's business model quite a bit. But who is this company Bending Spoons that wants to acquire Vimeo? The name sounds a little familiar to me.
Right, so Bending Spoons is an Italian technology conglomerate founded in 2013 that has made a series of acquisitions of various mobile apps. The most significant of these acquisitions, save for Vimeo now, was one of the once popular note-taking app Evernote in late 2022. By mid-2023, the company had laid off all of its US staff and relocated to Europe. A similar story to what happened to the team behind the video recording app, Filmic, when it was acquired by Bending Spoons in September 2022. This playbook might be what's actually needed for Vimeo to start afresh, as the business has been seeing revenue decline year over year, and while it looked like for a period the company had finally inflected to making net income, the company has started to struggle with profitability again over the more recent quarters. Vimeo's CEO had stepped down in August 2023 and went on to join Tubi, another video hosting services platform. The company's stock, Vimeo, was down nearly 93% during her tenure as the company's CEO. The new CEO brought in was formerly a VP of AI at Google Cloud, so quite a big name there. And for all intents and purposes, what he's done so far at Vimeo has been a success. He came in when the stock was trading at just $3 per share, and now it trades at just over $7 due to the announcement of this acquisition. Moving on to the buyback section of this podcast, last week we talked pretty extensively about the aircraft leasing company Air Lease being acquired by the Japanese company Sumitomo Corporation, and we spent quite some time comparing it to its larger competitor AerCap. Just to recap, AerCap is much larger than Air Lease, with $7 billion in revenue over the last 12 months and an enterprise value of $65 billion. One of the reasons that AerCap is so large is because it purchased GE's aircraft leasing business in 2021, as Larry Culp was working to slim down GE by either spinning off or selling divisions. We wanted to briefly mention this week that AerCap announced a $250 million increase to their existing $500 million share repurchase plan for this year, with the $250 million increase representing only about 1% of the company's market cap at announcement. However, the business has very steadily been reducing shares outstanding over the last few years, repurchasing nearly a fourth of their shares outstanding over the last 10 quarters, or nearly 2.5 years.
Yeah, they've been excellent at capital allocation. They were placing orders for planes during COVID when everybody else was running scared. And then eventually, when the stock was trading at or below a tangible book value, I think it was well below tangible book value, they were also buying back stock. Hopefully, they got a chance to buy back during the March and April tariff fears, which is unfortunately when we sold out of AirCap. Switching gears a little bit, one of the reasons we pay attention to all these special situations each week, and quite frankly, this podcast barely scratches the surface on the number of situations we run into each week, is the unique companies we come across that we would not have otherwise. A good example of that is Electromed, a microcap company that makes a medical device called the Smart West Airway Clearance System that helps clear the airways for patients with chronic lung disease. The company announced a $10 million buyback representing 4.5% of its market cap at announcement. I was looking at the company's stock chart and I was also looking at its financials, and the stock has more than doubled over the last 2 years. And this reflects the company's revenue and earnings growth during the last few years as both Medicare and private insurers started paying for their devices. There were some insiders who purchased shares a couple of years ago that got the timing exactly right because the company was actually executing quite well, and this execution was not yet reflected in the stock price. The company currently has about $15 million of net cash on its balance sheet, and while the stock is not particularly cheap, trading at about 24 times forward earnings, I can see why they want to initiate a buyback authorization in case the stock were to drop further and provide a buying opportunity for the company.
Moving on to the insider section of this podcast, one of our major stories last week was Keurig Dr. Pepper, or KDP's planned acquisition of JDE Peet's and subsequent split into two companies, one being the world's largest pure-play coffee and tea company, and the other being a leading North American refreshment beverages business. The market evidently didn't react well to this news, beating the stock down by over 20% in the last week alone. Often, following extreme price action, we tend to see insider activity, and KDP was no exception. We saw Eric Gorley, the president of Keurig Dr. Pepper's U.S. refreshment beverages business, purchase around $250,000 worth of the company's stock. He joined the business in 2015 and was key to both commercialization efforts and was a member of the deal and integration team for the creation of Keurig Dr. Pepper in the first place. And if you'll remember from last episode, we talked about the merger of Keurig Green Mountain with the Dr. Pepper Snapple Group to create the company as it stands today. Now, Mr. Gorley previously served as the company's chief commercial officer, and prior to joining Keurig Dr. Pepper, spent nearly 20 years in roles at Coca-Cola and Coca-Cola North America. We always like to see insiders with deep industry experience purchase shares, but the fact that this insider was also part of Keurig Dr. Pepper's first major business combination and restructuring is more of a positive signal. However, as mentioned last week, the food and beverage industry as a whole is a very difficult one at the time, and this restructuring complicates things much further.
Yeah, I looked at Eric Gorley's insider purchases. I wonder if he's excited about the merger and spinoff and whether he's more excited about the coffee business or the beverages business that he currently oversees.
Yeah, for sure. It'll be interesting to see which one he has more of a preference towards, especially since the RemainCo will be that refreshment beverages business, and the spinoff is going to be the coffee business.
Got it.
So moving on to the activist section of this podcast, over the past 2 weeks, we've seen not just one, but two different activists get involved with the payments and accounting software company, Bill.com. Bill.com's stock price is down about 40% year to date, and while the business does seem to be struggling with profitability, revenue growth, quite frankly, has been very impressive, and the company also managed to generate very stable free cash flows. Starboard was the first activist to get involved, revealing an 8.5% stake in the business, and nominated 4 different directors to the company's board in an effort to unlock shareholder value.
Starboard is generally a friendly activist, if you will, unlike Elliott. I wonder what the company's response was to them getting involved.
Exactly, and in a friendly fashion, Bill.com responded by pointing to their recently announced $300 million buyback, but then again, they also agreed to cooperate with Starboard. They used the buyback as an example of them already creating shareholder value. But shortly after all this, it was reported that Elliott had also built a roughly 5% stake in the business, though their position had actually predated Starboard going public with their stake. But unlike the typical Elliott playbook, the firm declined to comment on their stake when asked by a journalist investigating the matter. Elliott has actually taken stakes in various other payment companies in the past, including Global Payments in July of this year and a $2 billion stake in PayPal in mid-2022, with PayPal CEO Dan Schulman eventually announcing his departure in early 2023.
So you have a combination of both a friendly activist and a not so friendly activist, both involved. What do you think is attracting both these kind of activists into a company like Bill.com?
So Bill.com has been suffering as a result of the tariff policies recently. Revenue growth has been pressured as the company's small and mid-sized business customers are impacted mostly by the unclear economic and tariff policies. This uncertainty has caused many of their customers to trim spending, resulting in Bill.com offering 2026 revenue guidance that was below analyst expectations, hinting at customer volumes deteriorating. The company is also facing increasing pressure in the payments fintech space as a whole from players like Fiserv's Cashflow Central and Stripe Billings, as well as Intuit's recent launch of QuickBooks Bill Pay. Elliott and Starboard have hinted at Bill.com being a possible acquisition or takeover target for larger payment companies because, all things considered, the company has performed quite well in the past, as mentioned earlier, save for issues with the bottom line. It'll be interesting to see how these two activists work together, or if they work together at all, to unlock further shareholder value.
Yeah, you mentioned Stripe in that segment, and I was reminded of your earlier discussion about how these companies like SpaceX stay private much longer than you would expect. And Stripe is another example of one of those companies. I wonder if something like Bill.com would be a good acquisition target for Stripe if and when it eventually goes public.
There's a number of fintech players out on the market, so both private and public, which is probably why both Elliott and Starboard see some value in getting involved in Bill.com.
Yeah, there has to be some consolidation down the road. We've talked about Jared Isaacman and his company. There is Square that Jack Dorsey started, and so on and so forth. And now there are all these different companies that are building on the blockchain and Ethereum and so on and so forth. To wrap things up on this episode, let's discuss C Suite. And this time, not just a C Suite transition, but also largest pay package in the history of the C Suite. We wanted to provide a quick update on the Seaport Entertainment situation, and this was a company that was spun out of Howard Hughes and had declined quite a bit into the teens after the spin-off before rebounding in recent weeks on news that they managed to find a buyer for one of their properties near the Seaport area of Lower Manhattan. We covered both Seaport and Howard Hughes multiple times on this podcast, and I also have a position in the company in the Inside Arbitrage model portfolio. So it is a little bit of a surprise to us when we heard last week that the company has decided to part ways with its CEO Anton Nicodemus, and he will also be stepping down as the chair of the board. Usually you do see this happening where if the CEO is leaving, they also leave the board of directors, and that's what we're seeing here. The company's current CFO, Matt Partridge, will be stepping in as the CEO, and an interim CFO has been appointed while they look for a permanent one. I'm not quite sure what to make of this sudden departure and plan to connect with other Seaport Entertainment investors to better understand this situation over the next few days.
I'm curious to see if Bill Ackman will step in any capacity now that the company's CEO has left, even though that there is an interim CEO in place. I'm wondering whether or not his involvement will increase or decrease over time.
You make a good point. Bill Ackman in Pershing Square has a large stake in both Howard Hughes as well as Seaport Entertainment, and they want to get even more involved in Howard Hughes. But it'll be interesting to see what they say about this, if anything at all. To wrap things up for this episode, I thought it would be worth discussing the largest corporate pay package in history. Tesla's board proposed a package worth $1 trillion for CEO Elon Musk, contingent on him achieving some ambitious performance milestones over the next 10 years. Some of these ambitious goals include the company achieving a market cap of $8.5 trillion from the current $1.1 trillion that it has right now, the mass rollout of robotaxis, and the development of Tesla's humanoid robot business. The company has said that a large incentive pay package for Elon would help him remain focused on Tesla. But I wonder, as opposed to what? Getting involved in politics, starting a multitude of companies, acquiring companies, and then attempting to get out of the merger agreement, and numerous other distractions. The part I find particularly egregious is that Elon claims that this kind of stake in Tesla would allow him to ward off any activists that might try to get involved in the company. The board of directors already appears to be serving the CEO instead of shareholders, and this kind of grant would just cement that further. I wonder why Jeff Bezos, Bill Gates, Larry Ellison, and countless other founder CEOs don't require large grants from their companies to continue to remain focused on the company or to ward off well meaning activists. If maintaining control was so important, Elon could have set up the company with a dual class structure, much like Mark Zuckerberg has done with Meta, or companies like Snowflake, Palantir, and Airbnb. I guess not a lot of people remember that Elon wasn't the founder of Tesla, but he could have had the opportunity to reincorporate the company when he got involved as somebody who put in a lot of money behind Tesla and worked very hard on it. And he could have created the dual class structure if he wanted to at that point. Even companies like Ford Motor and New York Times are controlled by their founding families through a super voting class of shares. I'm not a proponent of dual class structures, as we don't know if Mark Zuckerberg's grandson will have the same business acumen as Mark does right now. But there are also other ways to incentivize a CEO instead of giving him a $1 trillion pay package. So, with that a little bit of a rant, we're going to wrap up this episode.
And we'll conclude episode 36 of the Special Situations Report. And as always, what we've covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as tools to help you access and identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.